Hi, I'm Howard County Council member Christiana Rigby. You're listening to the Conduit Street Podcast, the official podcast of the Maryland Association of Counties.
Hello and welcome to the Conduit Street Podcast. Kevin Kinnally here with Michael Sanderson. Michael, Thursday, May 22nd is when we are recording today. There is a lot going on at the local, state, and federal level. A lot of stuff we wanted to talk through, so we're going to do that today.
Yeah, I think so. I mean, this feels a little bit like, I don't know. I mean, there are news shows that kind of run through the day's headlines and then give analysis and context and that kind of stuff, and that usually hasn't been our beat. We tend to cover sort of the long form, long arc issues, but right now the headlines are full of stuff that feel relevant. So things are stuff to dig into. It's like today, this week. So let's do that.
Yeah. So for today, I think there are three things we want to get into and talk about. We saw both the state of Maryland and the United States of America have their credit ratings dropped. We wrote about that on the blog. So we want to talk about both of those issues. And with the federal to budget debates heating up, Michael, really heating up, we're going to make whatever connections we can with the federal budget and what it means here in Maryland. And I know that's a lot to get into, but we'll try and pack that in nicely to this episode. So, Michael, let's jump in first to credit ratings. Let's talk about that.
Yeah, I think my recollection is it was a year or two ago we had a guest on and did a whole episode on the general notion of credit ratings. We had Jennifer Deer from Davenport, who does financial advising for a number of our counties and for our post-employment investment board. She talked us through like what credit ratings are and how they come together and what they're used for. But I mean, I think in the aggregate, it's an overall grade on your credit worthiness. Like what you want is a high credit rating to tell investors this is a low risk investment. You don't need to get a high interest rate to invest with them because they're very likely to pay it back. It's very similar to your personal credit rating, through the credit scores when you get a mortgage or buy a car. So I think in the aggregate, the credit rating or the bond rating is basically like a credit worthiness score, and the scale is the better and higher you get as a grade. That's a signal to investors that you're a low risk investor.
Right. And, I guess to some listeners, while it's some sort of cheat code, as you would say, for investors sounds really, really nerdy, it's also, Michael, a very easy thing to point to as a measure of fiscal responsibility. We like easy ways to look at things and determine whether they're good or not, right? So this is even based on letters, and that sounds like a lot like a report card. So this is something that we're used to from grade school, and this is just a quick way to gauge someone's credit worthiness, right? That's what we're talking about.
Yeah, I mean, I think it's unrealistic to think that an individual investor or even an institutional investor like a pension system or a big mutual fund, for them to try and do all the homework and dig into the state of Maryland or the city of Los Angeles and look at their borrowing patterns and look at their previous budget process and other things like that. That's a lot to ask. So you get companies like Moody's and Standard & Poor's and Fitch, the three big well-known agencies, they hire people to do this for you. So they say, the state of Illinois is going to be a single A graded bond. The state of Maryland, historically, a triple A graded bond. So you should expect less interest from Maryland because they're a lower risk. You might want more interest if you're going to invest with someone like Illinois, who's a shakier circumstance and maybe a higher risk. But I think that also translates, though, to, in addition to budget fundamentals and your base economy, it also kind of gets into, management and administration and so forth. So there's sort of a prestige effect beyond the practical effect. I mean, when people use this as shorthand, it sure does look like a grade card. You'd rather have A's than C's, right?
Right. So with that in mind, the shoe fell a week or so ago. And again, we've written about that on the blog and we'll link it in the show notes. Maryland finally slipped out of the, quote, triple category, Michael. A handful of states for a very long time that had the best possible rating, AAA, from all three of those major rating agencies that you mentioned.
Right. So we got an inkling this might be coming from Moody's, for the big outfits. last year, and we wrote about that, and it was a conversation, sort of when MACO was out meeting the commissioners and county councils over the course of the year, saying, "Hey, there's fiscal stress. We know we have a budget issue," and sometimes the rating agencies will say, "We're not going to change your rating, but here's a few paragraphs about our outlook." And they changed Maryland to a negative outlook, sort of citing a handful of things, but saying it feels like the state of Maryland is vulnerable to changes with federal employment. And we got a number of things that are sort of on the state balance sheet that are not ideal, some long-term liabilities that haven't been fully addressed, and some things like that. So they sort of raised some flags a year ago, or sort of late in 2024, that set the stage for this. So if you've been watching this storyline, the news from last week wasn't a giant shock. I mean, honestly, Kevin, you and I have been whispering about this for a couple months, that this felt like it was coming.
Yeah, and Moody's did last year, Michael. You mentioned they kind of put the state on credit watch, on negative watch, and they cited structural imbalances and planned depletion of general fund surplus through fiscal 25, which undermines performance relative to peers. That was the quote. So Moody's did tell the state last year, look, we don't think you're doing enough to address your structural imbalance. We know there's a lot of chaos at the federal government. Maryland is uniquely suited to struggle in that scenario. So Moody's did tell the state, you need to do more. And I think, Michael, they were watching to see what the state did in the 2025 session. And apparently, because of this downgrade, they didn't feel like Maryland did enough to address the concerns that they outlined last year when they put the state on watch.
Yeah, I think there's multiple pieces here that, one thing that has obviously happened since like late summer. I'm trying to remember when the negative guidance came out last year, but I feel like it was in July or August.
Last June.
September. Okay, it was in June. Okay.
Mm-hmm.
So it's been almost a year now, but the federal election has happened, and we have a new federal administration. And maybe, an extra factor on top of things that were already on Maryland's, sort of like, liability list of, you got a pension thing, you've got an OPEB thing, you got a variety of things sitting out there that are not ideal, and you've got this structural budget problem. You layer on top of that uncertainty about the federal government and that workforce and so forth. I think, that may be, rather than, oh, it's because of what happened in the 25 session, I think it's like there's a new ingredient in the stew that makes a difference too. So, the context for these ratings is not just how strong is your economy, or how high are your taxes, or are you engaging in best practices for accounting or whatnot, but it's supposed to be overall, like, how likely are you to pay off your debts? If someone, buys your bond, are you going to pay them back with interest as you've pledged to do? So I think all that stuff mixes together, and it's tough to walk away and say, here's the thing.
And Michael, we know that the federal presence in Maryland has long been a source of stability for our economy. Doesn't really slow down when the overall economy goes into a recession. But right now, that feels like a bit of a weakness, the reliance on the federal government. But I want to go back to something you just said, which is it's supposed to be, how likely are you to pay off your debts? And Maryland State Treasurer Derek Davis, I think this week, made some headlines when he kind of talked about that and said, Moody's came to town. We all met with them. We went through all the financials. We talked to them. We sat down. And really, in his mind, this should be, how likely is Maryland to pay its debts? And his answer is, we're absolutely going to be able to pay our debts, just like most every other state. And I think he mentioned the last state to default was during the Great Depression. I think it was Arkansas. But Michael, should these rating agencies be looking at all of this, or should they just be looking at how likely are you to pay off your debt? And the likelihood is very, very high. And so in the treasurer's mind, it's like, well, why are you taking all these other things into account? This is supposed to be the likelihood that we can pay off our debt.
Yeah, I think it's a really interesting question. I think the treasurer makes a pretty good point that the universe for state level municipal bonds, kind of a weird term. They call them municipal bonds for everything that's below the federal government level. Folks who work and do policy in Maryland, we think of municipal being cities and towns, but in the finance world, municipal means everything that's below the Fed. So state, city, county, all that stuff is municipal. These obligations are really safe. Right? Like it has been, practically speaking, 100 years since there's been a problem. And even the Illinois and states who have relatively low ratings, like for 20 years, you've been able to get a bond premium. You better get a nice, juicy interest rate if you buy bonds from Illinois, and they pay them off.
Right.
Maryland has a special process where our property tax rate is set not by the General Assembly and not by the statute makers or the budget builders. It's set by the Board of Public Works, and meet on 2 weeks' notice and reconvene and set a new property tax rate. And that's deliberate. Like that's a way to say that's where we generate the money to pay off bonds. And for we call it the annuity bond fund. It comes from the state property tax. And if they need to raise the rate to meet the number that they need, they can do that like quickly and expeditiously. You'd think that Moody's would like the processes we have here, and they'd look at the track record of Maryland as we always show up. For our bondholders, they always get paid. Their principal, their interest always gets back to them. So I see where the treasurer is coming from. I think it's a good point in this aggregate. I mean, it leads you to then what's the point? What's the point of doing ratings on state level municipal bonds if they're all safe? Then why bother?
Right. And yeah, I think it's an interesting point, and certainly you can sense his frustration. And I think all of the fiscal leaders in Maryland, they're frustrated by this. Like, we should mention too that Fitch did affirm its AAA rating. We're waiting to see what S&P does, the other agency, and that'll happen before the bond sale on June 11th. But Michael, we mentioned that a lot of this seems to be because of the chaos and uncertainty in Washington, and that Maryland is uniquely vulnerable. But no one in this state, and if you look way back, we never set out to be fully dependent on the feds, right? I mean, this is not something that we decided, this is the way we're going to go here in Maryland.
Right. I think that's an important point. This has become a talking point we heard a lot about this, like dependency on the federal government is a weakness for Maryland right now because the federal government is differently positioned than it has been like for my entire lifetime. So I think there's an element of truth there, but it almost suggests that Maryland set out on a plan that we're going to just become, wards of the state, and we're going to build our whole economy around federal agencies and so forth. And like, no one did that. No one, but if the federal government says, because proximity to Washington and decision makers is sensible, would your state like to have the Social Security Administration in Baltimore County or NIH in Montgomery County? And the answer is yes, we would.
We would. No, right. All these jobs. Right.
And we have a good educated workforce, provide the kind of high level workers you need for those duties and responsibilities and so forth. So we're strong players for those kind of employers. They're different from the old Bethlehem steel plant, right? It's a different market. It's a different world. I mean, Pittsburgh and Detroit and Cleveland went through the same sort of thing as Rust Belt jobs mostly declined and office and service jobs mostly increased. And the American economy has changed. Maryland's economy has changed. So I think it's not like you would go back and play it differently. No, we don't want NIH in Maryland. We don't want to have Fort Meade here. I mean, no one would do that, right?
Right. Well said. Well said. And so, Michael, here we are. We do have a short and a longer term problem with the state budget. We've talked a lot about that here on the podcast. We do have a balance sheet with long-term liabilities for pensions and retiree healthcare. And now we have our most stable sector on the workforce feel a lot less stable. So we get bumped down only one rung on the ladder from AAA to AA1, still a very good rating. But again, no longer at the top of the mountain. We're no longer one of those AAA states.
Right. So when you get past the sort of political optics and the prestige factor, what does this really mean? In theory, investors, people who might want to buy your bonds, to give the state money so we can go build a new building at the University of Maryland campus. They give us the cash so we can go do it, and they ask to be paid back with interest. In theory, those investors are relying on analysis like what comes from Moody's or from Standard & Poor's or from Fitch. And when they say, oh, well, for AAA, I would want the lowest interest rate. And as the rating goes down, I might demand a higher interest rate. So this theoretically means those investors would ask for a higher interest rate. And when the state goes to the bond market, which we do virtually every year, I think every single year, Maryland goes to the bond market for general obligation bonds backed by the full faith and credit of the state of Maryland and all of its institutions. Every year they go back, the borrowing cost should go up by a tick. I mean, that's the economics of bond ratings, is when you're perceived as a somewhat greater risk, then you should pay somewhat more in interest, and it becomes more pricey to borrow money.
Right. So, I mean, easy way to understand this, I go into the car dealership and they run my credit. And that's essentially what's happening here. When the investors come and they want to buy these bonds, they're pulling Maryland's credit reports, and these three agencies provide those reports. And again, Moody's has now said, you're not at the top tier, you're now at AA1. Fitch, again, has affirmed that AAA rating. We'll see what S&P does, but that's essentially what's happening here. They're running Maryland's credit report, and Moody's is putting up some smoke signals saying caution.
Right. I think that analogy is fair. It's a good way to make sense of this. I mean, I think as a practical matter, the thing that's going to be tricky here is we're never going to know with any certainty how much effect this adjustment, if it's just one rating agency or if it's two of them, and they bump us down from the very top to the next rung from the top, we'll never know precisely. So we'll never see it itemized like on a piece of paper or receipt. If the yield on bonds from last year's bond sale was 3%, to simplify a little bit, and next year, this coming year, we come to the bond market and the interest rate is 3.2%, it might be tempting for someone to say, aha, there it is. It's the smoking gun. We just cost ourselves 0.2%, 20 basis points on those bonds, and that's all because of blah, blah, blah. But I mean, these markets move all the time. You can't exactly say, well, this year is exactly like last year. Everything else is exactly the same. So, we'll never know exactly how much effect this had on interest rates. I'm sure there's a regression analysis that some PhD student has done out there, or probably some AI bot today can say, oh, the difference between AAA and AA1 is exactly this or exactly that. But we're never going to know exactly what it is. But by the way, that's the magnitude we're talking about. Like if there's an effect, it's not that our interest rates go from 3% to 5% or 6%. It's like 3 to 3.1, 3.2, something like that.
Right. So it's a tricky headline for our state's leaders, and we have already seen various political actors point fingers this way and that way. No surprise. But the reality here is, Michael, that this is one more cost driver for an already stressed state budget, as borrowing costs ostensibly will get more expensive.
Right. And as is often the case in political debates, the truth is usually less thrilling and sexy as the headlines or the finger pointers would suggest. So, there's going to be back and forth about this. That's the nature of political dialogue and so forth. That is what it is. But for practical matters, that's really the bottom line. It's a borrowing cost issue. And if we were a marginal AAA and now we're a high-end AA1, that delta is probably not huge, to be real about it.
All right, we'll go ahead and take a break. When we come back, we'll get into a lot of stuff going on in D.C. We had an all-night marathon voting session last night in Congress. They passed a reconciliation bill. We'll also talk about the downgrade of the USA's credit rating. All that and more after the break.
When you choose Care First Blue Cross Blue Shield for your team, you get exactly what's in our name. Care First. We're transforming healthcare to make care more affordable and more accessible for you, your business, and your employees. With the support of a team dedicated to the health of your people and access to a network of over 1 million providers, we've got your back and theirs with care. Learn more at carefirstforbusiness.com.
Welcome back to the Conduit Street Podcast. Kevin Kinnally back here with Michael Sanderson. Michael, while we're on the topic of bond ratings, we also saw at least one of the three rating agencies downgrade the federal government's credit rating last week.
Right. So since we're talking about credit worthiness, we had two big incidents. Those of us from Maryland who watched our own state lose its perfect triple AAA. We also saw the third of the three credit agencies basically agree with the other two that had already moved the federal government off that AAA tier, moved them down one peg. And now it's sort of a unanimous agreement among the three agencies that the federal government is not at the top of the heap for credit worthiness. It's not exactly the same story because like the ice has already been broken. This isn't like when you put the knife into a new jar of peanut butter. It's a big moment because it's perfectly smooth, and that's when you finally break it. And that's an exciting thing. It's exciting for me at least, but
Right.
This isn't the same thing. But it's still kind of a story that once again, somebody who thought the feds were AAA until now has said, "Okay, we've seen enough. Now you're down to AA or whatever the next tier is."
Yeah, and like you said, Michael, we've already seen the two other big rating agencies make this adjustment, but I feel like this story is a lot more tricky to tell. You don't have the same localized economics effects like we do in Maryland, right?
Right. This definitely is a different sort of thing. It's more, I don't know, like it's more ephemeral. This is more vibes. Like what are we seeing in DC, and how much faith do we have that that's going to go right?
Right. And what we're seeing in DC, I mean, I think we all can agree, is chaos, right? And investors don't like chaos. They like calm situations. They like serenity. They like to know what's going on. They don't like this kind of chaos where they don't know what's going to happen tomorrow.
Right. In theory, if you're investing in the bond market, what you want is no news, right? You want nothing should rock the boat. I bought a federal bond, a 10-year T-bill, and I expect to get my money back over the course of 10 years with the stated interest without any hiccup. And so, without being partisan or political, I think it's fair to say, just as a general observation, this president feels and acts maybe less beholden to norms and traditions than any other that we've seen. I think a lot of his supporters would say that's an asset, that's a strength of his, that he's willing to think of things differently. But if the real litmus tests are things like whether we shut down the federal government or whether we're going to agree to a debt ceiling change in order to avoid sort of a fiscal calamity, you could see analysts, professionals who are trying to gauge the risk in that market saying, I don't know, I'm less sure now that the feds are going to come through than I might have been 10 or 20 or 30 years ago. I don't think that needs to be a partisan observation to say that we're in a different climate than we were a generation ago, and maybe our bond rating should reflect that.
Yeah, and to be fair, I mean, there are some long-term things at work here too, right? The federal government's budget making process has absolutely fallen apart during my lifetime. They don't do an annual budget anymore. They just do things piecemeal by piecemeal funding agreements, lots of continuing resolutions, that sort of stuff. It feels extremely just disjointed. And it's in contrast to what every state and every county needs to do. Nobody else gets to live the way that the federal government gets to live. And again, it's completely fallen apart. They can't agree on anything. They don't pass bills. I think the last, substantial bills we saw were during the pandemic. But they passed these continuing resolutions. They never passed a full budget. So one could see how rating agencies could finally look at this and say, okay, that's the last straw. Now it's just complete chaos. We don't have any certainty. We don't know what's going to happen tomorrow. We have new actors who are willing to, shut the government down, who are willing to do all sorts of things that we didn't contemplate before. The world has changed. And so a lot of longer term issues here. It's not just who's in office right now in the White House, but it's, I think, these systematic failures and institutional failures, or at least over my lifetime, that to me have led us to this point.
I think that's fair. It's not unthinkable that the federal policy making apparatus might be frozen at a time when they need to act to increase the debt ceiling and not default. Right? I mean, it's really as simple as that. And if you default on your debt, you've broken the pledge to the bondholders, and that's what outfits like Moody's and Standard & Poor's and Fitch are looking at. So, honestly, it's kind of a weird thing. Back in the day when I studied economics, and everybody from my generation and those even more recent, studied economics, it was sort of a bedrock principle that you talk about interest rates as a matter of relative risk for the investor. And I remember the conversation would basically be, the instrument that represents the lowest possible risk is borrowing from the American federal government, a treasury bill from the United States backed by the full faith and credit of the United States. This is Uncle Sam promising you're going to get your money back. That was always seen as basically the virtually no risk investment. I remember a particular teacher of mine basically saying, like, if you loaned your money to the federal government and they're in such bad shape they can't pay you back, we've got bigger issues than your $10,000. That we've got some sort of like civil unrest happening. That's the only circumstance where that sort of thing would happen. So that was always like the basis for interest rates. You start with the federal government as the lowest risk, and then everybody works from there. If you're Ford Motor Company, you have to give a little higher risk because you're not quite as solid as the federal government. Or if you're Bridgeport, Connecticut, maybe you're a higher risk, or blah, blah, blah. But now, I guess, I don't know how you teach that now. I don't know where you put the foundation for the interest rate market. But if U.S. Treasury bills are no longer AAA, then maybe they're not the rock solid foundation like I was taught back in the dinosaurs age.
And Michael, look, I think that's a good point, because there are a lot of people out there who would say, forget this noise, right? This is all noise. And that, do we really think that the federal government's going to default on debt? And maybe that's just me being naive. But there are a lot of people out there who would say, ignore this noise. Like, yeah, there's a downgrade, but what does that really mean? We know, I mean, ostensibly, again, it means that borrowing costs will increase for the federal government. The feds run a huge deficit every year, so they're borrowing more and more money to pay off the money that they borrowed before. It's a way bigger effect on the U.S. government than it is for the state of Maryland if their rates actually go up. But Michael, what is your response to, like your professor said, take it to the bank. And if they can't pay their money back, there are bigger problems. I mean, what is your response to people who just say this is noise, and at the end of the day, this doesn't really move the needle?
I don't know. I mean, I think my general answer is, for the most part, we buy into the wisdom of crowds. And in large, complex markets, if it really were the case that the city of Chicago or the state of Illinois is considered a risky investment proposition. Like the state of Illinois doesn't have a AAA, not even close to it. They're down in sort of the junk bond area as seen as risky and so forth. That should be a great investment opportunity if you buy the theory that a state is just not going to walk away from this. And maybe this creates an investor opportunity for folks to invest in U.S. Treasury bonds. If you're going to get a higher interest rate on investing with the federal government, you're still taking very little risk in doing that. And so getting a higher interest rate should make that very attractive, which should then self-correct. If
Right.
Lots of people flood into the market because there's a bit of a tick up in the interest rates, then you shouldn't have to offer the higher interest rates. And it should kind of find the Adam Smith invisible hand should kind of bring things back to a normal place. So if most right-thinking people see a rise in interest rates because of these semi-arbitrary decisions of people at Standard & Poor's or Moody's, then maybe the response is ignore that. And if the rates go up, jump on them, jump in it, right? Maybe that's the way this whole thing just gets resolved, that the market will really set the rate, not the analyst at Moody's.
Right. So, but the bottom line is, Michael, if borrowing costs do go up, it's definitely magnified on the federal score sheet, and that would be a big deal.
Yeah, it is. I mean, there's a number of things at the federal level that really, really matter. I mean, keep in mind, like you mentioned that the feds just play by different games than any state or any city or any county, and that's absolutely the case. We all balance our budgets every year. And that's in the Maryland state constitution, and it's a requirement of every county and every city in Maryland, and pretty much everybody at the state and local government level. You balance your budget. Meanwhile, the federal budget hasn't been balanced since 1991, I want to say. I don't remember when the last time was. I mean, but maybe 2001. I think the dot-com bubble suddenly balanced the federal budget for a hot minute. But as a practical matter, the feds run a deficit every year, which means they have to borrow to cover just operating costs. And what they're basically doing is borrowing money today to pay off the bonds from years before because they had to borrow money then. They've built themselves into a check-kiting circumstance And it's a much bigger deal for them. The cost of borrowing is a way bigger part of the federal budget than it is for the state of Maryland or any of our member counties. It's a much bigger deal at the federal level.
Well said. So Maryland has its bond sale on June 11th. We will keep an eye to see what the rates look like, how that goes, and we'll certainly keep you updated. And Michael, since we're talking about the feds and their budget, we might as well take a big swig of some more medicine and talk about the Congress and their efforts to make a long series of fiscal and policy changes in one big, quote unquote, reconciliation bill, Michael, the big reconciliation bill. And I think there's another name for this bill floating around.
Yeah, I think the big, beautiful bill, right?
That's
the nickname that our president seems to insist on, and a lot of folks really like. But the big, beautiful bill, the word reconciliation matters, but it's the big, beautiful bill. It's gone through for a beautiful bill, it sure has gone through like the sausage making process to reference an old political adage. It seems. We're recording on Thursday morning, and the House of Representatives has just gone through a marathon session. I mean, they started late Tuesday night and basically have been hour by hour by hour in briefings and in meetings back and forth and doing amendments and all this sort of stuff. They just passed their version of the bill this morning with literally a 1-vote margin on the floor of the House of Representatives. So that's as close as it gets. That is like skin of your teeth kind of stuff. And one abstention, which it may have been a costly abstention to find.
Yeah. So I mean, we're seeing the details. We will see them come out in the days ahead. I mean, like you said, they just passed this bill. The House did. I don't think we have all the details in hand yet. Big hat tip to NACO for staying on top of all this, the National Association of Counties, keeping their county members informed and representative. Here at MACO, we've been kind of triaging this, and there are some big things to talk through. Michael, you've been up to your neck in Medicaid numbers. What's the latest there? Because we know that has a potentially enormous effect on states like Maryland, every state, but particularly potentially Maryland.
Yeah, I think we've covered it on the podcast, and I know I've written about it on the blog. And yes, I'm probably spending an unhealthy fraction of my idle time trying to run sort of, keep the dinner napkin level math on Medicaid stuff and what it might mean for Maryland, just because the number's so gigantic. Like this easily could be a $2 billion a year problem for the state of Maryland. So like at that magnitude, you have my attention pretty close to undivided. So I've been pacing the floors on this. We don't have all the answers, but one facet that I think is really important is the feds tend to do, like in Maryland, we do a fiscal note on every bill. And generally speaking, we talk about the fiscal note or the fiscal cost or effect of a piece of legislation. We always talk about it as, what will this mean per year? The feds, their standard tends to be, let's look at the effect over 10 years and take the total effect over 10 years. I'm sure you could argue left and right as to which of those two methods makes the most sense. The feds sometimes end up playing games with their 10-year cycle. Actually, it's part of the reason why we need to do a big fiscal bill right now, is that back in 2017, what do they call it? The Tax Cuts and Jobs Act, I think, of 2017 included a number of tax cuts. And in order to make the 10-year score work for some of the budget hawks, they needed to have a bunch of things expire before the end of 10 years. So without action on a big bill this year, there's a bunch of very popular tax cuts that would be set to expire. So that's part of the reason why there's so much urgency to do something now. Anyway, Medicaid is part of the 10-year plan. Last night, there was an announcement that some of the elements in the Medicaid cuts, including probably the biggest among them, which would be to require that Medicaid recipients who are, by somebody's definition, able-bodied and able to work, are actually working as part of their contribution to their own sustenance. So you can't be idle and receiving Medicaid services. And how many people that pushes off of Medicaid into being uninsured, or how many dollars that translates to into lost federal funds, is not yet known. But if they accelerate that to a 2026 item instead of like a 2029 item, in order to make this plan look a little bit more affordable. These cuts to Medicaid, to the state of Maryland and to recipients in our state, they might be way sooner than we had been expecting. I mean, as of a couple of days ago, I was thinking about this as we're going to have a few years to plan for this problem. If this happens in 26, we're talking about months, not years.
Right. And Michael, when you're looking at, I know we don't have the actual number, but we're talking about pretty big numbers here, correct?
Yeah, I mean, the last number I've seen is in the neighborhood of 8 million Americans potentially lose their coverage under Medicaid and companion insurance coverage. So it's not necessarily that those people will all be without health care, but they'll be without reliable health insurance. That tends to mean fewer people get screenings. Tends to mean more trouble with pregnancies and neonatal care. It tends to mean more people who don't get preventive medication, vaccinations, other things like that. More people who are getting primary care at places like the emergency room, so that the hospitals get overwhelmed, and people show up at our local health departments and our clinics with serious problems that should have been treated by a regular doctor's visit that the family couldn't afford because without insurance, it's $600. I mean, all those side effects of uninsured populations could show up at every level of government and in our communities.
Right. And so that's obviously a concern for residents and, of course, for Maryland's bottom line. Another big topic, Michael, has been SALT. We've talked a lot over the years about this. This is state and local taxes, and we're talking about your ability to deduct them from your federal return. Back in 2017, the feds put a $10,000 cap on your ability to write off state and local taxes on your federal return. And along with the more generous standard deduction, that changed the way a ton of people filed, since it was no longer worth it to itemize. So, Michael, more people took the standard deduction, fewer people itemized, again, because that $10,000 cap made it beneficial to just go ahead and take the standard deduction. Now there are big talks about, raising that cap, and that, again, would have effects on states like Maryland.
Right. Absolutely a big deal. I mean, in practice, there were an awful lot of taxpayers who I think, used to collect sort of, here's the shoebox full of all the receipts for all of our various charitable donations. And, if we did this or that, and we had this expense, and we're going to be able to write that off as long as you can document it. And, filling out your tax form was this laborious process of entering in 50 or 80 different little items and so forth. I mean, I did that for years.
I know. I was going to say, you have all the shoeboxes. You're still waiting to get audited. Like we know that Michael Sanderson
it's a 7-year window, man.
All over the place. Yeah, they're all over the place.
But I definitely, I'm sure I have shoeboxes in my basement.
Oh yeah.
Anyhow, but like in 2017, after the changes, there were tons and tons of people where you can do all your receipts and all your itemizes, and you come out and you're still way below the new federal standard deduction. So like, well, why bother claiming whatever 90 items when the new standard is 24,000? Don't do it. That's foolish. So throw away all those receipts. Don't bother with it. I think that has changed taxpayer behavior a little bit here and there, but it's noteworthy at the filling out the forms time. But I think it emphasizes the effect of the state and local tax deduction, particularly if you pay a lot in state and local taxes.
Right, like Maryland. And so Maryland, it is noteworthy, and you have congressional leaders now pushing to restore the SALT deduction. The House bill bumps that cap up from 10,000 to 40,000. That is going to have a lot of policy wonks, and they already are, screaming and yelling on both sides, Michael. So this is a big deal. It's not going to get front page headlines, but for a state like Maryland, a relatively high tax state, this is a big deal for state and local government coffers as well.
Right. One of the factors here that makes Maryland different than most states, and particularly on this axis, is Maryland's made a conscious decision to be an income tax driven budget. So it's the primary revenue source for the state of Maryland, and it's a huge revenue source for the counties in Maryland. We're one of a kind on that front, and you can really easily itemize your income taxes because you have a form that you filled out from last year and showed what you actually paid in state and local income taxes. So to be able to itemize that, property taxes, on your federal return is easier than states that rely on lots of service and sales taxes. So if you live in a state that, like a state like Tennessee that has no income tax, they have lots of service charges and business fees and other things like that. Those are much tougher to itemize and claim as state and local taxes. In Maryland, you can just say, here's my income tax return, there's my number. So we end up being a place where a lot of taxpayers in Maryland had a sizable number that they could report to the feds. So this is a big effect here. I think on the political debate here, I mean, a lot of people, and I think myself or us, this podcast included, tend to look at tax policy on the scale of progressive versus regressive. This sort of, is the most of the burden spread equally among people with different ability to pay? Does it land more on the higher end or on the lower end? And folks make their own judgments about what's good policy there. This isolated decision, the idea to restore more deductibility of your state and local taxes, is going to show up as very regressive. This is giving a tax benefit to mostly people who are at the high end of the income or ability to pay spectrum. This is really helping only people who have valuable big homes, large mortgages, or big salaries.
Right. I mean, but I think there is a certain logic to it, right, Michael, that even if you don't like the regressivity, the principle of being taxed only on the income someone actually receives does make sense, right? So I think on the other side of the coin, there is this argument that why am I being double taxed?
Right. I think that's right. I mean, that's also why we have things like a standard deduction or itemized deduction. I mean, the philosophical concept of income taxes has always been we should be taxing the money that actually lands in your hands. And I think there's a really strong argument. I mean, we said this back when the feds in 2017 made this change and put a cap on state and local tax deductions. I think we on the podcast at least said, like, it's good policy to recognize that if you live in a state that has a flat 5% tax on your income and you make income in that state, for the federal government to tax you on 100 cents of the dollar, even though 5 cents of that is going right back to your state, that's absolute double taxation. You're never seeing 100 cents on the dollar. 5 cents is coming right off the top and going to your state. So the Fed wouldn't be taxing that element that you'll never see. You can't. Now, the system's never as simple as, it's one rate, top to bottom and so forth. But philosophically, whatever share you paid to the state government shouldn't be available to be taxed again by the feds. I find that logic really persuasive, and it doesn't fade even if you're only talking about people with big pools and fancy cars and stuff like that.
I agree with you, but maybe we are too bought in on the local government perspective here. I don't know.
Yeah, I mean, you got to be open to that, right? Maybe we've drunk the Kool-Aid from our friends at NACO and from folks in state and local public finance. Maybe we're just repeating the talking points. I don't know. I find the logic pretty persuasive, but maybe I'm just through the looking glass. I'm open to that.
Well, Michael, I mean, look, we're talking about all this, but with a one vote margin in the House and all these tricky issues, and we haven't even gotten into some of the trickiest, right? Can the U.S. Senate just pass this bill, or is this all just a dream? Are we wasting our time talking about any of this stuff? Is this bill, this big, beautiful bill, DOA, or is the Senate going to be able to move this bill forward, do you think?
So I think the big picture answer to that is kind of above our pay grade, but I'll offer one insight, and it's back on the fact that this is being included in what they're calling a reconciliation bill. Trying to understand parliamentary procedure generally is hard, but doing so within the modern interpretations and confines of the rules of the United States Congress is like, it's high level stuff, hard to keep up with. But I will say, while most things in the U.S. Senate, for all intents and purposes, require a 60 vote margin, you need to come up with 3/5 to pass an ordinary bill to avoid basically a paper filibuster. Someone can file a piece of paper and say, I intend to stand up till I'm blue in the face to object to this on the floor of the Senate. And just like filing that paper, you've effectively said, okay, if you don't have 60 votes, don't bother. If those are the general rules in the Senate, they have carved out a process for reconciliation of fiscal matters. And that's a pretty broadly defined term under their own sort of, rule interpretations through their parliamentarian and so forth. But it sounds like all of this is going through the reconciliation process where you only need 51 votes, not 60 votes in the Senate. So that puts it in play that if the Republican majority in the U.S. Senate can pull together virtually every vote like the slim Republican majority in the House of Representatives, they could pass a bill as well. If you cast the tie-breaking vote, I mean, these votes could be really close. You don't want to give an absolute veto to one irked senator from the majority party. But so the math of getting it passed is not as titanic as it seems. You don't need 60, you only need 51.
So there are bound to be a lot more things to talk about once the big reconciliation bill moves into its final stages and now as it moves on to the Senate. So we'll certainly keep in touch through the Conduit Street blog with all the details, especially as they affect counties. Of course, we'll be talking about this on the podcast, but make sure to subscribe to the blog every single day. There will be articles about this, issues that are kind of part and parcel to the federal budget process. So a lot of stuff going on the blog and on the podcast. And Michael, we shouted out NACO earlier, but just point folks in that direction too to make sure that they know how to get to NACO and that they can follow along there because there's a ton of resources on the NACO site.
Yeah, I think we'll put a link in the show notes, but NACO.org is the website for the National Association of Counties, and they've been doing a great job trying to follow these issues. It's tough for us small fish in our small pond over here in our state legislature to try and follow federal issues. It's really complicated. It's a whole different language and policy and process and that sort of thing. So different for us, but NACO's doing a great job. Visit the NACO website, sign up for their updates. They have been the boots on the ground, and hats off for them for both representing counties well, but also keeping us up to date on what the latest things are. So great work by NACO and a lot of interesting stuff still to happen in the week or two ahead, I think.
Yeah, they're doing a lot of webinars, Michael, which I've been impressed. And you can sit down, they record them, and they're just little snippets. You can learn a lot in a little bit of time. So I agree with Michael. Head to NACO.org. They have a ton of stuff there. But we'll go ahead and leave it there for today. If you enjoy the podcast, please go ahead and subscribe. That way, these episodes will be sent directly to the device of your choice. You can also follow along on social media, Facebook, Twitter. And then, of course, as we said, you should be reading the Conduit Street blog every single day. But for Michael Sanderson and for our esteemed producer, Chantel Malcolm Lim, this is Kevin Kinnally signing off, and we will talk to you soon.